Hey everyone, I've got Karim back on the Finding Value Finance channel. My name's Andy, I'm the host, and we're just going to look at a couple of videos, or I should say charts, a couple of charts here, see what's going on in the markets. And we're probably going to focus more on gold to silver ratio, the overall kind of markets, if they're going to kind of roll over here, what clues should we be looking at, kind of looking at that type of stuff. So, I mean, that's kind of where I'm at. It's kind of why I wanted to get together and say, hey, what the heck's going on with this market? We're seeing
the
a
end
lot
of the world,
volatility.
Andy. It's the end of the world.
It's weird because yesterday we saw these huge reversals, and the reversals, like in uranium, in oil, and it's when the Fed came out. But I mean, they came and they just reversed quite dramatically, and it looks like they're selling off today too. So I'm wondering if this is going to be like some overall market meltdown or what. I don't know.
Thanks again, Andy, there for calling me. Yeah, we could go. Man, yeah, I'll show some charts there that I'm looking at where it's recently. It's like, I don't know. Sometimes it's not 100% like the past, but there's some key charts I'm looking at where it's like, I don't know the expression, the analogy I could say. It's like holding on to a wet bar of soap, and either you manage to hold on to it and crisis averted, or it just starts slipping, and then like the VIX starts crescendoing up, markets sell off more and more. The gold silver ratio, I'll show you the relationship why right now like silver's selling off, and that after that, when that starts getting out of control, it's like it's the panic button, right? So it just feels right now that until everything's like more controlled, until the DXY starts trending downwards, until the gold silver ratio once again starts trending downwards, we're at risk of these type of events happening until the markets could grab a hand on that there. So I don't know if it's what are they waiting for, but as a chart trader, we could look at the charts and see the probabilities of a continued sell-off. But again, amidst all the fear, that's the greatest opportunity, because I remember back in March of 2020, even if the charts were telling you you're like silver, I don't know, was in the high teens or mid teens. How low did it go in March? $11, $12 silver? It's hard to see clearly when everybody's going crazy. It's the end of the world, COVID, markets, they'll never go back up again. And this huge sell-offs, and you can't even breathe, even if you have access to charts and you know that that's probably a great opportunity. So I'm afraid like the same thing's going to happen again. Right now I see on Twitter people getting nervous, and then after that, like, I don't know, when you keep seeing red after red after red, you think it's the end of the world. But when you take a zoom out, see, Jesus, we're still doing higher lows, like let's say the lows of March returning. Now we try to go over 28, 29, let's say for silver, then we're coming back down. Then if we're able to turn that corner above important moving averages, then it was just a pullback within a long-term uptrend. And all this noise, all this whatever narrative people are trying to wrap around why this is happening in the end of the world scenarios, they kind of freeze you, these scenarios, right? Like these short-term narratives where you just can't see, like, oh, commodity bull market's over. And then I'm starting to hear like this Kondratiev winter. I don't know. Did you hear about this winter thing there?
You're talking about the Kondratiev waves?
Yeah, and so like somebody says it's a winter coming. And look, the winter is here in Canada. I don't know if it's in the charts, but
yeah,
right.
I was afraid of what you were going to say after you said it's like holding a wet bar of soap, and I was like, uh-oh, what's going to happen after that? if you drop that soap, is there some sort of ramifications? But
man. All right,
should we throw a chart or two up and see what the heck's going on? I was looking at the housing starts last bull market, and they actually, I could go and show this real quick before, just to show something real quick. The housing starts here. Let me back out real quick. We were coming across in 96, 97. We broke to the upside in 98. That's where we got our commodity buy signal. And that's, I think it took some time to get some traction. It takes about 2 years for the inflation to get into the system. So if we broke this in 98 here, and we just broke it today, kind of like in the 2020s, 2021. If you look at silver, let's say, silver really didn't start to take off till I'd say 01, 02, where it started to really start to come up. And it was really 03 that it started to get any sort of movement. So I'm just wondering if we're just early. I mean, is that the case? Are we just early here? And the inflation hasn't come through the system? Or, I mean, that was driven by bank lending. We've got all this money that they threw into the system that they printed, and it's all artificial. Would that be the catalyst that drives this thing higher? And I don't have an answer. I mean, I'm just trying to figure out roughly when can we expect this, because I see it's down 3% today, silver.
Yeah.
And I'm just like, what the heck's going on?
To know for early, the first chart you could pop up, or I could pop. Can I share, or do you want me to do this?
Oh yeah,
Andy?
go for it.
Do
You can
that.
share. I didn't have multiple screens on.
Screen, okay, share. I have to move. Okay, there you go. So let's say, to definitely know if we're early or not, the gateway drug, or the gateway XAU USD, the gateway chart for all of us, like the whole commodity sector. And I'll compare it against the Nasdaq, because that's, or if we could do it with the, I'll start with the weakest of the US indices.
The Russell.
Yeah. I love picking on the Russell. So this one, this has to start to, okay, it's rare I do it this way, but this one has to start turning upwards. So this is how we know we're early. Where's 2000? Okay, so let's look at the 2000. So here's the US the gold in
dollars.
Gold in dollars divided by the Russell. So right now Russell's kicking gold's butt for all these years. Oh, and here's like something happening. So now gold's kind of refusing to, so gold actually broke out against the Russell, Jesus, in 2002. So here there's probably some buy signals. You could have probably zoomed in, and there's probably, I call those angles, those breakout lines. Well, maybe not this one here, but the wake up signals, the steeper the angle of a trend line that's broken, a valid trend line, the earlier you are. So let's say there's a violent downtrend, and for 3-4 points, then you break out. Usually that's not the first rally that goes up back to all-time highs, but it's a big jolt, you know, and everybody gets trapped, but it doesn't go, it goes maybe a quarter or halfway, but it stays close and then goes down. Then you have another one. But as time moves on, these trend lines, they're less and less steep, and the crowd usually gets in on the horizontal breakout line. And after that, the fear of missing out crowd gets in on the opposite, on a parabolic breakout above an incline trend line, which is like, means you're close to the end, right? When you break up, let's say of a rising wedge, and you break out to the top, that's usually like, it might blow up, but that's probably the end. So the steeper the line, the first ones, the earlier you are. So somebody could have probably gotten single like gold, let's say right here in 2000, right here. So, oh man, this is it, gold's breaking out. But as time moves on, it kind of needs, you need to carve in higher lows. It takes a little bit more time. I'm just doing this exercise back there. So what we're going to do, we're going to do it today, and we're going to be able to see. So now you break out. Oh, but now it's starting to test more and more flat. And these are the lower risk entries. And even this one here, you see it's starting to get to be a flat breakout. It explodes higher. It doesn't go all the way back to the moon. Then you're starting to define, hitting some resistance. Can't get back above. Then comes in retest. And often these retests, people say, oh, it's bearish, but this could be happening right now. We could just having a retest of a critical wake up line. And what folks don't see, unless you have a big picture, here's the big low. And look at that on that pullback, higher low. This is probably, you could probably see Grady do a lot of these charts, and people think it's the end of but actually this is a higher low, same fractal, but from a higher, more strategic position upwards. This is uber bullish. If this would have been like, if this line would have broken down, then because we could have said, okay, we need more time, but man, so here's an early bird.
I
I'm wondering if that's us, right? Because remember in 2000, the markets hadn't probably totally rolled over, right? The Nasdaq, it's in 2001, it started really rolling over. So we could be, well, we'll see where we are today.
that chart right there that you have, that entire piece, I call it the booty bottom because it makes a bottom. REMX has that same exact bottoming pattern. So does copper, like COPX, to the T. It looks exactly the same.
Check it out.
And the way I always look at it is you have momentum coming down and that momentum has to get worked off. So you have buyers turning that momentum back up as we go up. That's the way I see it too.
And that's that's exactly what's happening. Which one's for copper? The copper versus the Nasdaq? You saw that?
It was just REMX and COPX was the COPX. It wasn't a ratio. It was just the
okay, got it.
Yep.
Yeah.
REMX, definitely. You can see that one if you click that. It's the rare earth strategic metals. It's a massive. Yeah, there's your bottom, your double bottom. And I call it the booty bottom. Now it did have a little bit lower low from the COVID type, scare, but I would throw that bottom out because it was a news event, but that's just me. And then it would go straight across for double bottom.
These well, it depends, like the behavior you see, like this type of lower low, it creates wedges, and wedges, they're it's extra capitulation. So it creates energy to the downside, and that helps it even rocket more. So also this, when there's a lower low, it's actually also super bullish, and it did it here. You see, there's a descending trend line. And then after that, there was a capitulation to the bottom, right? So this channel or wedge, oh no, broke to the downside. But remember, like I said, on the inverse, you see this in the Nasdaq stocks. What's happened? Let's say I invert. A lot of these SPX, like, when you break out, I'll show you, like they break out, the software sector broke out to the upside. Oh man, to the moon. But often these are blow off tops. And then what happens is the reversion to mean. And then you...
yeah, that looks like a lot of the Nasdaq type companies. In fact, that looks like Bitcoin too.
Yeah, a lot of them. Oh, man, let's see. Look at that. Let's and that's the total edge we have. Let's say I put here
yeah, but that looks like the top to me. I don't know. I mean, that's what I see. Looks like you think it too, because you already have all-time highs there.
Well, yeah, it's look, if the I think Bitcoin's destiny is tied to it's tied to the Nasdaq's or the software sector, and right now it's on the wrong side of the moon. What I did this morning, I'm over software sector, software XSW. Yeah, I did this one. I was just working on this one and remove indicators. And what's happening with the software sector, it did the same thing. It's is that on log? So it broke out to the upside. So that's super like melt up type of price action.
Yep.
And yeah, but what I'm trying to get at, okay, it's more the NDX that looks like Bitcoin on the daily chart. Reset chart, remove drawings. So this daily chart for Nasdaq, and where did I have it?
Because I was charting Nasdaq and it looked like it was rolling over to me, but we'll see what happens.
Well, check this out. Yeah, and well, it's definitely in the topping fat. The Russell showed us a while back. The Russell refusing to go upwards for a while. It was already stalling ahead of time. And here's the Nasdaq. I just did this one this morning, and up, sideways move. So this is the definite line in the sand for the Nasdaq 16,500. The support right now, you see these wicks refused even on a daily close. So it's right there. So it's trying to. This could be either top. but now it's on the wrong side of this diagonal breakdown line. So remember, like I said, the steeper they are, the less it still has energy upwards, right? So it's probably going to want to retest that line. And if it gets back above, fine, it's back in formation, and then it could probably try to go upwards. But it's probably going to come and want to retest that line. And if that line fails, then it's going to come and retest that support line. And one day it just can't hold on that breakdown line, and it's going to falter below that horizontal breakdown line. So, oh man, it's not on the good side of the moon at this stage. I just got to let so yeah.
And if
So
this
this-
all breaks down, you think it's going to bring everything else down with it, all the other commodities, like a deleveraging, like there's
Yeah.
everything's so leveraged up that people are going to have margin calls and all this other stuff. So they'll start selling everything. Or you think it's going to be a slow kind of like just kind of coming over and it just leaks out?
Look,
Tough to say.
yeah, it's tough to say. And because we see it, it's like, if it would have been a smooth transition, like the silver, I don't know, it would probably hang in there a little bit better than it is now. Everything feels really, really shaky. So, but eventually okay, so let's go back here. This is going to tell us, this is like the gold to the Russell. So you see, it takes time. So where are we today? We'll come back to the gold silver ratio because you're right. Jesus, minus 3% silver. So here is so we're probably like, Jesus, we could be actually right here. We could be, yeah. Well, it's so weird because the market, yeah, 2004, 2005, we could actually be right here already. And what's kind of funny is amidst the markets not having topped like they did back here in 2001. So sometimes I see some and fractals from 2004-5 for silver and gold, but in these ratios and even in the gold silver chart, like they already seem that they've turned a corner without having the market like really topped. Or maybe
you're thinking we're kind of around the 04-ish time frame.
For a lot of my charts, yeah, I've seen
like 04, 05.
Yeah, there's a lot. Like let's say here, look, the analogous move distance from the moving average. So here we coiled around the 3-year moving average for silver. Same thing here, broke out, important base, pretty much the same structure or time. And after that, we exploded upwards, consolidated close to that 3-year moving average. But it brings us to 2005, and gold, pretty much the same chart. But back then, 2005, if we look at just let's say the Nasdaq, 2005, it had completely, it was unwinding like big time off that high. Look at that. It's deep and it's a bear cycle and it's already trying to recuperate. SPX. So it's kind of weird. It's like sometimes I see that as uber strength in the precious metals, that they're able to perform that much amidst US equities sapping all the capital and sapping all that. The US equities refusing to really show a lot of weakness like it did. See, look, this huge correction had happened when the precious metals started rising right here. That's insane. We haven't had this drop in the US equities. They've been actually melting up, right? Look, a 47% drop from the SPX to start fueling the precious metals. But look at that. It's like practically the inverse that's happening right now. Maybe this is what people are been calling like the crack up boom, right?
Yeah, I'm just worried that when this thing unwinds and goes down, that precious metals may have another year or two to consolidate, because people are going to be selling all these different assets across all these sectors. So it's going to act as a resistance to the move upward, just like it did before in 2000 to 2002.
Yeah.
Then we saw it take off in 04, 05.
And
so that's why I said, are we just early? I mean, is that because I mean, if the Nasdaq were to collapse here, I find it really hard to believe that gold and silver would go up in the face of that, not collapse, but if it were to pull on back. Or do you think it could diverge and have gold and silver pull up in the face of the Nasdaq pulling back.
Well, I've heard that one that it depends how hard, like you say, is it a liquidity event? Is it a 20-30% crash like March Madness here? Even in 2008, let's say I overlay these charts, the gold chart, and I'll put the so here's my gold chart, and well, look at that. You see how it recuperated a lot. I'll put the wicks so we get to see the intraday. It gets messy.
Because the one thing I didn't know is how these things are going to diverge. I think they're going to at first dive, and then gold and silver will take off. I think they'll have that initial kind of deleveraging event. Not the deleveraging of stocks, not the deleveraging of real estate, I should say.
Gold bottom, the month at bottom, 5 months ahead of the US equities. So at the beginning, when everything starts faltering downwards, gold's going to take a hit. But you see, it gets 5 months of that's
well,
that
was a real estate crash. What about the peak of the Nasdaq in 2001-ish or so?
Okay,
because I think that's really the one that I think we're going to go through, is exactly like the year 2000, 2001.
Well, if it's that, it's even better, because look at that.
Yep.
You're getting 24 months of added value being in precious metals and friends with amidst a bear market in the US equities. So how much?
I think that's what's going to happen, is similar to that.
Look at that.
Because it's the same exact spot that we're in.
Yeah. And gold dropped how much? So when the Nasdaq peaked, gold dropped an additional, hold on, I have to put down a different scale. Move to new pane above. So when the Nasdaq, let's get some details.
Yep.
So here, gold, I'm going to put my marker. So here's the Nasdaq top. So let's start from a fair. So let's say gold was already here, already dropped ahead, kind of sensing, and then it did, it bottomed right there, 8%. When 8% down, after that, it refused to go down more than 8% after the top of the US equities. US equities went down 26% from the top. So I'm just went, and then after that, it went down another 30%. And how much did gold go up until gold went up?
It's a big move.
Yeah, 52%. So that's going to, the ratios at this stage, now they're really turning. So if I would put the SPX to gold ratio, now you see you're above. Okay, that's what I wanted. I get sidetracked.
That's gonna turn like heck.
Yeah, exactly. And
that divergence.
Yeah,
that's where you make all of your purchasing power gains.
That's what we want to see, to really know that you want to really know that you're in a precious bull era where you're not going to get that the capital flows are really going to be back in your favor. That's when you know you're at a good spot. But I'm going to pop up okay, let's look at the gold to SPX ratio. So 2003 here, bullish 1 year, 3 year moving average, 2001. But the party really, that's pretty much where it started. Here, like a lot of charts, any charts, when I start seeing that right here, these are starting to get great buy signals. So until this happens, look, it hasn't happened yet, man. Jesus.
We're early.
We're early. And I'll just show you, here's a distance from the 12-month moving average. I'm going to put my vertical ray. So this one is probably the real ghost signal. Look at that. We're just starting to trend upwards, man. We're like, we could be.
See, I think we're like in 98, 99 or something like that.
It looks like it. Look, so here's my horizontal line. We could be, we're right here about. If this is the move that brings us above the 0 line, above the 1 year moving average, and not one of these, we're pretty much here. We're right here.
We're we're correlated very well with almost exactly to the housing starts, because the housing starts break up and then it takes about 2 years to get into it, which could be 2022, 2023, where things start to come on up more so.
Oh man, it looks exactly like this. And here I have a falling wedge. So often you'll see these in arcs. So there's capitulation going down, crazy momentum down here. Like I'll zoom in here, guys. So that, but after that, it starts slowing down the momentum and creates a bullish falling wedge. And
Well,
as soon as that,
you can do the same thing. See those candlesticks and the size of the candlesticks as they come down, that they're contracting in opening and closing prices. I know it's a ratio, but that also signals that the buyers are starting to equal the sellers. I see that all the time.
and so it starts getting flat. What that means is you're not distancing yourself from the moving averages as much. The moving averages are starting to get flat. You're catching up. And here, look, this is probably a pivot line. This is probably the ultimate breakout line. When we cross that line, it's going to be a full-on fury for precious metals. So Jesus, we're early, but you know what trapped us? What's kind of weird amidst these ratios, because these are ratio charts. Gold is above its quarterly defined all-time highs. It's crazy. It's like since 2001, something really strange happened. Is gold has kept going up even with this ratio, or still like not being a bottom for gold, because this was actually a bottom for gold when it started turning up. This is not a bottom for gold. Gold's much higher. It's from a more strategic, higher perched area. And so as this ratio resets, but gold's price is always higher. So you're using that ratio like an oscillator. And when that ratio starts turning upwards, you know that you're ready for another sustained leg, like a decade-long leg in precious metals, outperforming SPX. So yeah, that's super impressive in gold's favor. But we need this ratio turn around for silver to go up, because silver is going to have a hard time having capital flows going in until this really starts turning upwards. So yeah, we're kind of early.
With knowing this information, what kind of strategy could we deploy as investors? Because we know we're early, we know it's going to be volatile, we know that it may not go up a lot. I mean, but we know it's coming and we know it's going to happen, I would say, with some reasonable certainty. So is this a spot where we would want to cost average in irrespective of what the charts look like, or should we maybe buy the metal and hold off on buying maybe the mining companies? Because the mining companies, they're leveraged to the hilt against the metal itself. Like, what strategy could be deployed here, knowing what we see through these charts? Because that's what I always think of. It's like, you see an opportunity, what's the strategy with it?
Well, I think you kind of thought it out there. So in these precious bulls era, it's gold's going to be the front runner. So gold at this stage, when I see a chart like that, I probably the gold's the one who's going to get less hit in a market liquidity event versus like all the miners and silver. And it's also the first one that's going to lead off. And that's what, as soon as gold can break out of its, let's look at the gold chart. So as soon as gold can break out above this line, remove drawings. So, you know, everybody's looking. So even gold now, it's in a super bullish configuration, man, even like what's happening today. So gold's going to be the first one to get out. So yeah, indeed, at this stage, you probably want to have, it's kind of weird because the gold silver ratio is pretty high, but if we focus on the SPX that hasn't turned versus gold, then yeah, gold would be a good place to have some assets. And when it's really starts turning upwards, then you'd want to look at this chart, the chart that sucks the most, the Huey. So the Huey is the gold bugs index.
Yep.
And when that starts outperforming gold, hey, it's not that bad actually.
Yeah, it's flattened out.
Yeah,
it's just going sideways.
Not that bad.
So it's like it's like we're so close.
That's actually a quite bullish construct right there.
I know, because we got the momentum coming down, we've gone sideways, and it's like, when is this thing going to launch here to the upside? And I own a bunch of gold mining shares in like mutual funds and stuff.
Look at that. So here's my ratio. I'm on the linear chart. Bullish expanding wedge. And when it refuses to come and touch that bottom line of these bullish patterns, bullish expanding, sometimes I can't even say the words. Then when you know that you turn around and you can't reach the bottom one, you know that it's, so when did this happen? 2000.
Notice how the ratio was only, the mining companies only did well in the beginning of the last bull market from 2000 to 2004, 5, 6.
Yeah. And I've noticed that. I did a tweet a while back unless the dynamics change and we're in the 70s or like, because everybody now we're looking at what happened at miners versus gold in a disinflation cycle, right? Because gold was going up since 2001, but since 1980, we were just like living small inflation within a still descending inflation cycle. So there's data we don't have. So the dynamic could be different if we're back in the 1970s and the miners really like start being behaving like they did. But you're right. So right now, based on this data, I would definitely like to be heavy on miners. As soon as the gold to silver ratio, the gold to SPX ratios turns up, it's miners. But after that, I don't know for what reason, like maybe, maybe like the CEOs, they start spending, we hear all the narratives of like why they stopped.
Usually on the back half, oil does pretty incredible things too, which might be their input costs. So their margins get squeezed.
Yeah. Wow, look at that. Oh boy, Jesus.
So, see, it's close.
Oh man, but look, okay, so let's do my exercise. I always look for the most steep of importance. So the longer the trend line, but it's going to be probably steep. So right now, this is the wake up breakout line. There's nothing wrong having entered. And look, in 2019, what happened in 2019? Gold started breaking out. The power here about these lines here, yeah. 2019, look, June 2019, that's exactly when gold broke out. This was the wake up line. So there was nothing wrong with being bullish gold at this stage. Everybody, this was the early single. You could have been long gold here. It was at 1350. It went up all the way to 2000. Now at 1800. And look at that. So now we're getting less and less steep. So here there's this critical pivot line, and man, it's right on it. It's like Jesus, like. So that's not a steep angle anymore, man. There's a lot of hard work that's been done. This consolidation period for the past 2 years. How long is this? This 2-year grind was actually the start of the rotation out of US equity slowing down. 31 months. 31 months? That's what, almost 3 years now? It's been going sideways. It hasn't done a lower low. So
I was just going to say that the lows are coming up into that line.
Man, so this could be, and there's this thing called reverse symmetry moves.
Yep. You just flip that chart over.
Yeah. So these are probably my next 2 targets. It can happen pretty fast. So once we break out above this line, you probably want to be long miners until you hit this line. And if it breaks out of this base, then you're long miners until you hit this congestion area here. And if that breaks, then you're going to want to hit that. And usually the angle of, where's my angle line? How come I don't know TradingView by heart? It's crazy. Right here. So this, I'll make it as fat. Or maybe not. Okay, 54-degree angle trend line. So if ever we break, wherever we break out 54, this is going to give you a clue of how fast.
Oh, I see.
Yeah, because it's often the same. So let's have a base. No matter how long the base is, fine. But as soon as you break out above the horizontal breakout line, then that's because there's no sellers on the way down because it goes down so fast, or the quantity of buyers on the way down is equal to how long it stays at that price range, right? So the steeper it is, that's why you have moves. The faster it goes down, the faster it goes up. If it goes down slowly, then you might have a grind. So whenever we break out November 2022, whenever we break out of this line, I'm expecting a move. So here it could give you a target of when to sell your miners, when in favor of gold, right? So this is probably the speed at which this thing is going to start climbing once it gets out. And that's when the cost opportunity disappears. And now that's when you want to get in.
So you're saying basically you have it kind of breaking out 2020, end of 2022, beginning of 2023. If it were to break that line coming up.
That's what a lot of people get upset with
Yep.
me because
Because
it hasn't broken out of this line yet, right? This so this line is scalable. So let's say we grind for another 2-3 years sideways. Well, this line is still valid, this trend line of what's going to happen, but it could just get scaled, right?
Yeah, you can just slide it depending on where that thing breaks and breaks
exactly
the 21.2 ratio level.
Yeah. So let's remove all this, remove drawings.
So
then the next breakout line. So here's your boobies. So as soon as we break out above this line, there's a reverse symmetry move.
The double bottom.
Here, 63, 63 degrees. So as soon as we break out of that line, the move is going to be pretty violent. It's going to be 60. So is it reasonable to think that maybe in June of 2022, we break out above this line? If it breaks out above this line around here, then we could have a crazy move all the way to April 2023 for the miners versus gold. So let's not get greedy about the long term, but on the shorter term, if I would post a chart right now, this would probably be my roadmap. So wait for this. You see this sell-off of the Huey versus gold to slow down. You're still above a 3-year moving average, higher lows. So this could be actually a good turning point, and you're going to start getting out of the cloud. But this looks pretty bullish, actually. So we just have to wait for the turn to happen for the miners versus gold. So
would this be a good buying opportunity, you think, right at this kind of area then? Because this would be the low, right?
Well, you got to wait for the chart to prove to you that this is not going down here. We don't know like how low this thing's going to get, right? So that we could circle back and finish like with the gold silver ratio, what's happening with US equities. Because if there's a sell-off in US equities, this could actually go down all the way like to some let's put my squiggly line. Like like it could dip here, start tracing a bottom here, and then move up out of this thing, right?
Yeah, so you're looking at 0.14 to 0.13-ish, maybe 0.125, if that were to hold as a higher low in the ratio. So, I mean, we're pretty close to a bottom. So if someone were to cost average in over the next 5-6 months, you're probably going to get all throughout this bottom-ish area.
Yeah. And if
it holds, then we don't have some weird event.
Well, if it holds, but Jesus, look at those long-term ratio charts that we just looked before, you know. Gold's not doing lower lows. It's a higher low. They broke out of these bases. So that's why like a guy, it's like, okay, if ever guys, you're fundamental guys or you're chart trading guys, and you always look at one chart or one theory why the price moves in a certain action, you're putting yourself in a corner, because if that falters, you're blindsided because you haven't seen the 10-20 other theories or narratives that are like all intertwined, all these moving parts. So that's why we looked at the SPX to, or the Russell to the gold, to the silver, the cycle charts. We look at gold that's doing a higher high, or we looked at that silver chart. Remember that one I showed you on Twitter that's actually breaking out. You know, this helps really situate yourself. Am I in 1987? Because a lot of people are saying, Patrick, maybe we're in 87, but structurally you see you're above the cloud. It's not like here, even when you broke out above the 3-year moving average, you were barely making a headway versus the cloud. The equities to gold ratio here were awful in gold's favor, right? Gold wasn't breaking out at all versus US equities back in 95. So yeah, we're honestly, when you weigh the probability, Andy, if somebody wanted to start averaging, just in case this puppy starts turning upwards, this is the drawdown.
Yep. In 87, the housing starts was declining, and it was not a good time to buy, in my opinion, because we were going into a crash. So just to give you some more info on housing starts.
And that's why people have to follow you. They have to follow people. Like, I didn't even know about the housing starts until like somebody told me, hey, go check out Andy's Finding Value Finance YouTube. all that stuff adds up, guys. All those charts, all that behavior, all those elements, you got to put all that stuff together. And it gives you, where you are in the cycle. So somebody would have not looked at the housing starts, or somebody would have looked at the housing starts, would have said, oh, okay, hold on. I don't have all my buy signals, like all my ducks aligned.
In 87, with the way it was dropping on the housing starts, I would have went into bonds.
Jesus. So there you go. Because the rates were still going down, right? The bonds going up.
I would have gone into bonds because rates probably, I'm just guessing, I don't actually know. They probably collapsed all the way till 91 or 90. Because if you look at 87, it was declining and it went below the average in 88. So
yeah, these are the Canadian ones. Yeah, I see it broke down kind of, even here, they started breaking down.
Oh, that's Canada's housing starts.
Yeah,
so that will be, I think, analogous to your guys' currency and what the inflation is in that currency. Now, if you draw a line across, yeah, that line right there, you're breaking to the upside. You're going to get quite, if you guys can, if your demographics support a higher housing starts, you're going to get good amount of inflation.
Jesus.
If that breaks and continues. I don't know what your demographic looks like in home buying years, but.
Oh yeah, I love that chart. I don't even know where you got that. The one with the showing like the millennials are coming in.
Mm-hmm.
Economics, Canada. Guys, I'm showing you all my secrets. This is crazy. On TradingView, they added this thing called economics. I used to have to go get this in QuantDL, but now for all the countries, there's like there's a
inflation rate and stuff.
There's a whole bunch of look, that's the inflation rate. Look how well it tracks for the Canadian inflation rate and the housing starts.
Yeah, it should track pretty well, unless they were printing money or something was going on, trying to influence stuff, which the United States has been doing that since a little bit.
Look at that. That's a one. Here,
yeah,
here's a classic breakout.
It's going to be a big one.
Yeah, retest, halfway flag. And it looks like, yeah, it's going to halt here. If it doesn't, then the targets are all the way up here, 91 targets. And then 81. Well, oh, yeah. You want to, okay, before I forget, I have to do the gold silver ratio, guys.
Yep.
This is the tricky part right now. So for short-term traders and until the volatility, like me and Andy, we've been not arguing, but like, is everything going to crash down before the metals come up, or is it going to be a slow transition of capital flows from US equities while they stagnate more like in the 60s or 70s, and then sustained capital flows keep going in precious metals? I could show that chart after what happened in the Dow, because that was kind of a smooth transition into commodities back in the 60s in silver before because gold, it's so weird because it was pegged, so it kind of messes everything up before 1970. So this, guys, is the tricky part. So the gold silver ratio has been acting like a financial stress indicator since 2000. It's been tracking pretty much the DXY and the VIX. And this is not super duper good, guys, for risk on. So this is pretty much risk. I'll put a horizontal line. I'll put that thick line here. Okay, here. This, even here, not good if it closed a month above that. And even here, this bull flag right here, pull flag, because TA, guys, it works for everything. So if I remove my bias aside that I think long-term or longer term than this chart, gold and silver, and the, like we saw a Huey chart and all the miners and all the way evidence, I want to see a wick by the end of the month here. Here's a 3-year moving average that could help keep this under wraps. This is slippery slope because, guys, remember when this went up like that, it was March Madness. Gold was telling you, look, in February, it broke out. February, 1 month before we had March Madness. Gold silver ratio was telling you something was really wrong with the whole US equities and everything there. So if this happens, we could have another wick just like that, some crazy event, spike up. And that would probably go in line with this chart I just did today.
Yeah, the only thing I'll say there is back then we had bond yields dropping like mad before that event. Now we have yields rocketing higher, breaking to the upside. So I think what it's showing us is that the equity markets could roll over here. I mean, that's my worry, and how that interaction between commodities and the overall market is about to collapse, because I'm seeing yields go up, and yields are going to put pressure on stocks and the Nasdaq. So I'm watching the overall market starting to deteriorate, and I think it's going to grab all of our stuff and pull it with it for a short period of time. So
yeah, it's almost it's hard to see. Yeah, it's almost inevitable. Look, 2008 crisis, guys. Look at the gold silver ratio, how it told you ahead of time. It told you ahead of time.
I got one second.
New price scale. So let's put the Nasdaq, move to new pane above. Okay, remove. I'm just overlaying the. Okay, here it is. Log. Here it is. So you see, even before there was a total market meltdown, the gold silver ratio was telling you something was up with US equities back in even August of 2008. So that's super scary. So you see gold and silver were doing fine here. The gold silver ratio was going down. Even US equities were going up. You just want that to, for me, I want that to stabilize. So I'm not going crazy right now. The 2% move today, gold silver ratio, by the end of the month, I've seen so many months start off with the price, with the that ratio going up, but after that it gets subdued for X reason. Just here, guys, look at that. So this has to happen by the end of the month. Remove the Nasdaq. Patrick, the lines. What's that line doing here?
What about throwing the 10-year yield on that?
Well, yeah. What's the
top
ticker
of the-
for the yields?
TNX.
TMX.
TNX. There you go. 10-year yield there.
So new price scale. Here it is. Okay. So here's my yields. So the yields were dropping in 2008. They spiked here, then they kept dropping. So the yields were dropping. They have always been dropping for a while, actually, here. And now the yields are either going up with it. That's what you mean.
Yeah,
here, right
so
here.
that's what I was saying, is we've got this divergence kind of with yields going up. I think the overall market's going to roll over. I think it's going to drag some stuff with it. People are probably going to run to gold. Gold may drop with it just more slowly.
Yeah. Well,
And then it'll release and break, I think.
here is the, where's my square? See, they did go up, they spiked up here. So I'm wondering if this spike up here is what caused the damage. What happened? 2000. See here, look at how they spiked before. Same thing here. See how they spike? They have a jolt up, and that's what breaks the markets. So they spike up, then the yields start going down to try to save the markets, but it's too late. Then the gold silver ratio goes up. So this spike up right here, yeah, this could be. You're right. It could be a, but the structure is not the same because this has been going up for a while. The yields.
The way that I view yields is, if banks know what's going to come, like let's say the bankers know that something was going to come, they would pile into bonds first to protect themselves from a market crash. So what I'm gauging in that market is that the banks know something's coming, so they're all piling into bonds, and it's like they know something that I don't, but it's an indicator saying something bad is coming. Because they're positioning first before everyone else. They're positioning into bonds, drawing the yields lower or forcing the yields lower.
Man,
So
did
that's
you
the way
listen-
that I'm viewing it. Now, at this particular time, since we're going into an expansionary phase, I view it as they're selling bonds because they know that it's an inflationary period that's coming. But I think we're going to hit a speed bump with rates going up, maybe, where it's gonna crash the market like it did in 2000, 2001, where we started to roll over and come back down. Because
Man,
rates price the derivatives market prices the stock market. The stock market is a derivative of the bond market, because your rates are what, if you do future cash flows and you discount them back to today, your interest rate when it's lower prices the assets higher. So essentially the bond market prices all assets in the world, if that makes sense, through the interest rate, especially the 10-year.
yeah.
And depending on what the outlook is on the banks, they're either going to sell it or buy it based off of the rate of inflation. So the housing market ultimately and the demographics prices all assets in the world. As weird as that sounds, at least that's my conclusion. Through interest rate. Yep.
It's this would happen in the 60s. So the US equities went sideways as the rates overall were going up.
Yep.
Here, the US equities.
That was in an expansion phase of real estate with higher inflation rates, but somehow we still had a decline in the overall market. Because from 98 to 2008-ish, we had that housing market boom, expansion phase.
Yeah, that seems to be a big, honestly, man, that seems like a big game changer there. A big cycle, macro, like tidal wave that is really hard to stop.
Because we see the stock market always go sideways, and that's when interest rates, they did go up under that period. If you look, especially on the back end from 2000 to 2008, you saw the rates kind of come up, but I mean, they were in an overall declining environment.
You
were up just on it there.
Yeah, it's an illusion. That's why often I don't look at nominal, but I look at rate of change. And the rate of change
there.
Yeah.
Yep. And when did gold and silver take off? They took off right before that interest rate.
Yeah,
movement.
2003 here, like the bottom, 2003,
and that's when gold and silver started to move quite dramatically.
Yeah, that's why I'm super bullish. Like if the rates could keep going up, we're having another one of these. Like even 2016, we had kind of some success.
So that was a precursor to the housing starts going into an expansionary phase. Something happened in 2018-19 that broke the markets. That's why the repo market was going crazy in 2019. And then they came in with a flood of money. Well, I should say QE. They had QE there to bring the rates back down because it was causing problems. And then all of a sudden, the medical event happened right then and there, and they just flooded the whole markets with a bunch of capital. But if you draw that downtrend line on the 10-year yield going down, just taking the hits at the top there.
Yeah.
Yeah. Now don't hit the top of 2018, cut through it. So yeah, do that. It's like right there is where I think we were about to break out there, and they did QE and brought it back down.
Well, yeah. So that becomes like a kind of a pivot line.
So we're breaking back up again right now, out of that downtrend line.
Yeah.
If you were to zoom in at that
corner, I see it right there.
It's going.
It's coiled right below, broke out. And look at that, guys. So we got to kill this thing that rates going down is what drive goals. It like, look at the rates going up here. That's when silver went ballistic. Look at that. And then another shot, adrenaline shot.
So my theory on that is,
look at that false breakout to the bottom.
When rates go up, it forces the entire bond market to sell and move money into something else. They got to move it
They got to move it.
because they're going to lose a bunch of money. I mean, a bunch of money if rates start going up like that.
And
It forces action,
yeah.
and it hits stocks too.
Yeah. Well, that's what's gonna, the stocks here, they're probably, but these stocks, it's kind of tricky. So the US equities went sideways, but the dividends were a lot more in US equities back then because maybe of the higher interest rates or to attract people. So, so I'm like, this could be happen. Like this could be happening for the next 10 years in US equities there.
Mhm.
If we're anywhere in these type of regions here, even the 60s, like even, I don't know where we are exactly, but it could just go sideways for forever. So the dividend yield paying companies, companies in the commodity sectors, that's what when this cycle really starts trending upwards, that's what you want to be in. And look, that's why in the big picture, higher lows. And this is what's impressive for silver. So even if this is going down, every time there was a jolt of interest rates going up, silver has been doing higher lows. So sometimes like that, higher lows. Oops. Did I stop sharing? No.
No, you're good. I think.
See, higher lows, higher lows. So every time it's gotten a jolt of increasing rates, it's done its job. I could have put gold at the bottom. It looks even better for gold.
So here's my question. Has gold and silver ever gone up with rates going down? I don't think it has.
It's crazy, right, to think about it that way.
Well, they've never gone up when rates were going down. They've always gone up with rates going up.
I think I've done some.
The narrative of what a lot of people think, I think, is almost backwards. And what I mean by down, I mean by like a gold sometimes lags a little bit and it tries to predict things.
Exactly.
But the money supply in 08, they did a lot of QE in 09, 08, 09. And that's when the reflation, it priced it all in, but there was nothing to sustain that move in the real estate market.
Yeah, that was like the final this. So there's moves, yeah.
Yep.
It can move down with the rates, but like you said, gold is it can discount ahead of time. So even if the rates are going down, it could say, okay, look, this is I'm still turning, like it's refusing to go lower. It's sniffing that it's unsustainable. And then if that turns back upwards, it's
in that period though that you're going over on the right hand side in 2019, they did QE to hold rates down.
Okay.
That was an artificial suppression.
Well, that's why
it's funky because they're starting to play with everything, and then our indicators start to go all funky on us.
Well, yeah, so that's why I come back to the US. Oh, it's kind of funny that the US dollar inflation adjusted, and this is like the one that tracks the most. I'll flip the gold chart or flip. Wait, there's too much stuff here. X TLT. Bye bye. Okay, here. So the ratio, I'll put it. Okay, so let's flip. So this is the chart for me that tracks the most. So here's the DX. This is the black line here is the DXY inflation adjusted, but I adjusted for producer price index since it's like a little less hedonic adjusted than the other one there, the CPI.
Yep.
But just to give and gold often gold started going down ahead of time. It kind of sensed that the DXY would not go up anymore or would not go down anymore at inflation adjusted. And it kind of broke out ahead.
The dark line is gold, right? The black line is the DXY.
Gold,
yeah. Yep.
So what happened in 2008 or here? So you see gold refused to do new lows. So even when the US dollar was gaining strength, because I inverted that chart. So even as the US dollar was gaining strength, inflation adjusted. So as that thing's going down, gold diverging and saying, I think this the US dollar is about to get a devalued, adjusted for inflation, and gold started turning up. So here it's actually a big, huge buying signal for gold also as that broke out. And here there's a huge breakout. That's why it's hard to be bullish. Move here. Even put candles. That's like a huge breakout for inflation adjusted. It's consolidating above a critical breakout line. Like how could you be not long gold? Unless, yeah, so gold has to, I'm wondering right now.
Well, which chart's driving which one? Do you think the DXY PPI, or do you think gold's the actual leader there?
I think gold's the leader.
I
So
think so
this
too.
is kind of sketchy right now because gold is trying to guess if this thing's going to come back lower or this bull flag is going to keep going up. Man, that kind of looks like the copper chart, this thing here.
Now, I'm just going to go off a deep end here. If gold's the leader and it's leading all of these inflation indicators, what motive do you think these guys have to hold gold lower?
Well, like somebody posted, they asked me, when is there going to be a great reset, or when is there be a, like, okay, I have fun. Like I'm saying, let's say I'm in the government or whoever wants a reset. Why would I reset now? Why would I hit like the atomic button now when I could just stretch this on and wait until we get into like a Turkish type of situation or Argentina? Like why would I reset gold price now to 20,000? I'll just wait and stretch this as long as I can. And then when it goes parabolic gold, then I'll do a reset. But to get back to your point, I think that the only advantage would be to slow down this angle of ascent of gold, because as the more it goes start going parabolic, then that end game where they have to hit the reset is going to get, they'll have to do it, right? Or so if these, but I don't know which, like if they suppress, how could they do that? So they suppress the price of gold by shorting it, and then everything's looking at gold. Oh, gold's going down, so all these other charts are not going to break out. Like,
well, it's the leader of the commodity complex. So if they could essentially hold gold down, they could essentially hold the entire commodity complex down, because think of it, the way that I think of it is commodities are priced against gold, and gold's the inflation measuring stick, which prices the entire movement up or down, the entire commodity complex through the ratios that they retain over long periods of time. So the inflation measuring stick is gold, and we price everything against gold. That is what used to be money back in the day. So that's the way that I view it.
Yeah.
I don't know if that's 100% right, but
the whatever's going to happen, it's going to track. So let's say we don't know if it's the leader or the egg or whatever, the goose or the chicken, but I just killed that analogy. It will eventually track. So that's why this is super scary. So this has to break out to the upside, which is looking, so we have to, honestly, as time moves on, it's looking a lot better than 2013. I deep dive this topping structure, and it's really not quite the same. Like it's coiling tighter here. So the future of everything is through this chart right here. So if gold breaks out to the upside, we're gonna have a crazy up leg. And look at that, like look at the guys, man, the magic. I think we went over the copper chart, but look at the copper chart tracks exactly gold, the DXY adjusted for. Look at that, man. So then again, I have to go back to classical TA as my only guide. So let's say I do not know about fundamentals. I do not know what the hell's the Fed's doing or like what power they have. But when you see a chart like that, pull, flag, tight. Yesterday, I was super happy because this was looking really like.
Well, copper looked like it was going to break to the upside of its pattern.
Move drawings
on the short-term basis, but it turned down a little bit just recently.
Yeah, just like yesterday or today, right?
Yep.
So our future, the destiny is right. So that's looks like a bullish expanding descending wedge. But these patterns often when they break out, they're it's bullish this. So right now it could be just a back test. I know I don't have multiple touches. Let's go on the weekly. I might have some more touches.
Yeah, that's how I drew it right there. Exactly like you have it. Yep, to the T.
So yeah, pull, flag, breakout, retest. So this thing has to, maybe it's going to go all the way to the apex, scare everybody, but shoot upwards. And then we'll be in a situation where we'll kind of be, see these type of, man, that one looks pretty much, that looks
Yeah,
like
they're all roughly the same. They have these 3 humps. They've got a smaller beginning one, a fat middle one, and then a smaller third one if it's a descending wedge.
And here's our 2000. This one is really aggressive. This halfway flag that just really rocketed upwards. So we gotta look, Andy, we're not that far away. We have to let the market either implode, we go down. I get some hate mail on Twitter and there's some people asking me not to post anymore, but that could be the side of the bottom. The more I get people telling me to stop posting my rocket ships on the silver charts, that maybe that's the best thing that could happen.
We got to start buying, huh?
Well, look, we're guys, look at the chart, all the evidence we went through today. We're these type of situations right here where we're pull flagging. If all these things, which Andy, like everything's financialized, like you say, and we're really close. So whoever's leading, one of these charts is going to lead the other. So we're either going to do like this, pull flag, pull flag, unless this is a top, some type of pull flag here that totally fails.
Yeah, I don't think there's no way it's a top.
Like a 2000 and 2011, guys, you got to remember. So every time like I start getting 2011, we were in a 10-year run. The gold silver ratio was at 40, 45. The SPX to gold ratio was already starting to turn down. Like there's a whole bunch of evidence that you have to weigh why those were tops back then, you know. And no, this definitely looks like a halfway flag. We just got to let this thing iron out, let the traders, the volatility work itself out, and then get ready. So I think I was all over the place today, Andy.
No, you're good. You're good. That has the 3-wave consolidation pattern too in it. It has wave 1, 2, 3. Another thing is Bitcoin has that same topping pattern as copper did in 2004 to 2011. It has the same type of 3 humps, and then it comes back up, and then it'll roll back over. There's your humps are right at the top in 2021. Your humps there, yeah, and then it comes back up and then it rolls over. It's this chart here in Bitcoin is a compressed copper chart. The same human interactions over time. Same with SM Energy too. It's a compressed SM Energy chart.
Insane.
To the T. It's just compressed way together. So it's cycling through its thing very quickly.
Fast.
It's quite ridiculous.
Yeah, I know. And that's what's super impressive about the crypto sector. It was like, I was seeing all these fractals, but Jesus, they were doing it 7 times faster than like us dinosaurs in our silver and gold.
Yes.
What do you want me to tell you? It's like crazy. I had to put the time frame here, like let's say 2 months candles.
Yeah, it's 2011 was the peak, I think, for copper. So it'd be before that is what you'd see. And it's a very similar chart. The way it looks. And yeah, so the 2008 type peak is what 2021 is. And remember the movements of, yeah, that whole grouping is that big move. It's, yep, you got it.
Okay. And
then the run up before it is very similar too.
Yeah, I got it. Wow. Yeah, you're right. Yeah, that false hope, right? And often that's why these breakouts, it's like a breakout. It's just a close above an all-time high, one touch. It's not, that's why we have a hard time. Gold, what's fun about gold is it's consolidating above its one touch. So let's say I put the gold chart back and I put it on yearly or quarterly candles. That's the one touch, but it's consolidating above that that area. So it has to hold this also. Yikes. I hope that's not a copper chart again.
No, because it doesn't have the humps like it did in 2011 for, I don't think it's the same. The reason I don't think it is because we got the housing starts are rocketing higher. So I think this is a big cup and handle pattern that's going to break to the upside.
Yeah.
It's going to be a massive move.
And look at that, guys. When you
That's
put
my
the
guess.
on the buy on the 6 month on a 6 month candles, look at these retests every semestral test
Mhm.
above the breakout line.
That did the same thing back in the 70s or was it 70s? It did the same thing. It broke to a new high. Or maybe it was 2000s. It was the 70.
Yeah, exactly here.
Yeah, 70. Yeah, it broke out. It stayed above it, and then it just took off like no other. But it
Exactly.
paused there for a while.
Well, you see, this sometimes I've often found that the volatility of the correction we're having now resembled a lot the type of correction we had in 2008. So that's another type of fractal I've often noticed, like the power of the 30% drawdown or whatever it is, kind of reminds me of this here. So look, I've done a whole bunch of charts. I've done so many I forget, but whenever gold goes above its all-time highs, it doesn't stop there. It just doesn't. Every time it's went out above, it had another leg. So even here, like I go back in the in the 60s. So this is the third fractal here. So not the 60s, but the 70s. So every time it's done a pattern where it went above its all-time highs, here in 71, rocketed. Above its all-time highs from this peak in 74, rocketed. Above its all-time highs from the 1980 peaks, rocketed. Above its all-time highs from the 2012, it's going to rocket. That's what I'm like. Like I've seen this, and the corrections, yeah. So it retests here, it retested here, like it didn't even come close to retest. Here it got to here. So let's see if this holds there.
And every single expansionary phase, gold has rocketed. It was under those conditions.
Yeah. So Jesus, I think we just guys, stop staring at your screen every single day. Stop trading. I'm kidding. But yeah, it's a lot of noise on the, like, I know traders, they could do it, trade up, down, left, like scalp, like if that's your daily job. But the big moves, like I think that if we could recap the session, we're still early. So no matter how emotional or enthused I am, it's because I'm seeing the early warning signs of something big happening, right? And if this is just the beginning, then holy Moses, man, there's going to be some nice moves there still coming up ahead.
Yeah, I'll show you one last chart here if you want.
Yeah.
just to show you something here. Let me pull it up. Should be okay. Here we go. Let me share my screen. Just to show you, this is the annual U.S. housing starts from 1890 to 2015. They said that we had high rates, interest rates went up from 1940s all the way to 1980. What we did is we had this average of housing starts back in the day here. And in the 1929 crash, if this was the average, it went below the average in about 1929. So the 1920s crash was driven by real estate. The crash or the big move in the 40s for higher interest rates and all of that inflation was the demographics coming back, I think, from the wars, buying a bunch of homes, turning on the housing starts, and going to an entirely different level up here for the average, which means this is inflationary. So this inflationary piece went from the 40s all the way till 2000 or 1980. Then we had a disinflationary period here where we had lower, I should say, the demographic was a little bit lower and we didn't increase our housing starts to any new level. So by looking at this and the way that I'm going to try to, and obviously I'm trying to correlate things and explain it, and hopefully this is all right. is when we go to a higher level of housing starts, when we up the average that much higher, that is a new level of inflation in the system. And we're coming into a shortage of housing, which will drive the housing starts higher and higher and higher, which will be, in my opinion, inflationary. But I don't know if we're going to go to a new level. So I don't think it will be like the 40s to the 80, but it will be inflationary, and it may be similar to what it was in the 2000 to 2008 era. So I just wanted to share that, show you. I had that
That's
chart
insane.
there for you. Yeah.
The housing starts were back at levels last seen in the 1930s there. It's crazy how that dip went low.
Yeah. That dip was absolutely incredible there. You're talking about this dip.
Yeah, look at that.
All the way back to in this region back here.
Well, you know, look, from a TA guy, if you would have drawn a descending trend line from the 1950s all the way, and all those dots,
Right here.
the 1990s. So now that we have a false breakdown to the downside, and now it should be an opposite reaction to the upside. That's going to be insane. You see, like, yeah. So we've seen all these charts, right? So false breakdown, and so that means the energy in the housing market is better strap your seatbelt on, man.
Yeah, it's coming. It's coming.
But there's deflation coming, Andy. Don't you understand? It's deflation. You don't know anything.
If I saw that housing starts roll over, then I would say, yeah, it's deflation, definitely. But it's not. We're going up, which is crazy. Massive inflation, in my opinion. Man. So,
well, I'm happy to talk to you because it hopefully it helps remove fear. Because even me sometimes, like if I wouldn't have my like chart universe, I would be super scared. If I imagine myself just starting to invest, I'd be every headline news, deflation there, inflation there, and you get your brain get whipsawed left and right. Like say, what the hell's happening? And it helps seeing like stuff like that to take a breather and say, guys, Jesus, yes, there could be a deflation event, but on the long term, the odds are that this, like we're feeling the turn right now, and that's a generational opportunity, a turn. You know,
there's a lot of people on YouTube that have obviously channels, and they're taking the position that housing's in this massive bubble. And if it was in a bubble, we would see high inventory, we'd see a rollover in prices, and then we would see a drop. But with the housing where it's at, and it's important to understand this because a lot of people are looking at it, they're saying, this guy says it's in a bubble. This guy says it's in a bubble. I'm like Han Solo over here saying that we've got more room to go up. And it seems like everyone disagrees with me, and I don't know why. But the only person who doesn't disagree with me is the bond market, which that's the one that matters because they're selling their bonds and interest rates are going up, which means they agree with me. But if everything hinges on that housing start, if housing starts go up, you're going to get your inflationary period. You're going to have interest rates go up, and then gold and silver are going to absolutely destroy it. I mean, they're going to kill it. So it all hinges on more loans coming into the system, and that's going to be sustaining for that time frame. At least that's the way that I look at it. And I don't know how I'm wrong because the inventories are so low everywhere that your inventory can't just go like this and go up 700 or 800%, where we could potentially go down in housing, because you have to have at least 6 months of inventory. We're at 1 month of inventory. So it has to do a 6x of inventory levels to get to a spot where we could potentially go down in house prices. We've never had a decline in housing prices under 6 months of inventory. Never.
Jesus.
So these guys saying that we're in a bubble, I'm like, how is this possible? The historical data doesn't support that line of thought.
Well, it's because it's like we're like, I used to say that like the US index is in a bubble. It's been in a bubble since like 2011. Like we could keep saying that, but if it's above an inclining 12-month moving average, because the word bubble is emotional, we shouldn't even say it, because how could you trade that word? It's in a bubble. Like, okay, it's in a bubble. The bubble could last 10 years, 20. Like, it's those words. It's just better to look at the data and just see where it is, right? Man, it's a constant battle.
A bubble to me is something that is valued very highly in relationship to other things at that time. So it's over inflated or the valuation is completely full, so to speak.
Yeah.
But that's not the way that I see it. It's definitely not the way I see it.
Awesome.
So that's all I've got. Patrick, anything else that you've got?
No, that's I think that's enough there. I don't know how many
Okay.
people are going to watch this to the end there, but there's tons of information there. It's always fun talking with you, Andy, doing charts live like that there. It's
fun for me. Yeah. I really appreciate you having, coming on here too. I learn a lot because you're looking at things from a little bit different angle than I do. And that's why I'm like, I want to see what you have to say and kind of what you're seeing in a lot of the charts. And you pull up a lot of ratios that I don't normally look at. So, I mean, some of them I look at, and some of them I don't look at as much. And you hold more weight on some that I don't look at as much versus, others. So it's always good to see that.
teamwork.
So that's good. All right.
Cool.
Well, that's all I've got. So thanks for coming on, Patrick. I appreciate you being here.
All right.
And we'll see you next time.
All right, Andy. Ciao, man.